So the Very Good Food Company crashed hard on Friday. In this video, we'll cover why it crashed, what I think about it, and what I'm doing with the stock right now. Stick around to the end for that. Welcome to the channel, The Paper Bag Investor. I've been investing since about 2009 with a 30% compound annual growth rate. With this channel, I share my investing ideas and investing philosophy. My investing strategy is to look at and analyze the business of a company itself, and then when I find phenomenal companies at great prices, I buy large, or at least relative to my conviction level, I buy that amount. So if you get value out of this video, make sure you hit that subscribe button down below. When I get to 10,000 subscribers, I will be doing a face reveal and finally be able to breathe fully again. But seriously, if you enjoy this, make sure to subscribe for more content like this. And please, please, please hit that like button down below. Really does help the YouTube algorithm. Okay, so the Very Good Food Company, it's a small amount of my portfolio, literally just couple percent of my portfolio. So to be very clear, it's not the highest conviction company for me, but I do have conviction there. It is a high risk investment. The market is freaking out right now about it, as they were recently down about 20% in a day. YouTubers like Jeremy from Financial Education, who's been a big fan of this company, was trashing the management or really complaining about the management just recently in a couple videos. So let's have a look at what happened and try and make sense of it. Okay, so here's what happened. In essence, it's more complicated than this, but in essence, they issued up to 15 million shares at a price of $2 per share, which would raise up to $30 million in proceeds and dilute the company around 15% of where they were at the time, about a $200 million market cap. These are in Canadian dollars. $200 million market cap, issue 15 million shares, $2 a share, $30 million they can raise, 15% dilution. The market didn't like this, and they had a major 20% plus drop, and has trended even a little bit lower since then, at least up until the time I'm recording this. 15% dilution is a lot, but they are in a position where they really do need the capital. Last quarter, Very Good Food Company, they went from 17.2 million to 5.9 million in cash on hand as they are scaling up operations, building out the company. They are going to burn through a lot of cash. And they have access to a $70 million line of credit, but the interest rate on this credit is 9.95%. So definitely not a road you want to walk far down as a company, because you could be very burdened with large, painful debt. So rather than borrowing debt, they diluted and issued equity to the markets. But the markets didn't really like this move. They may have seen it as weakness. Maybe they didn't like the size of the raise. I think it's a combination of it's the size of the raise and it's the lower share price or market cap of the company, which means the dilution amount of 15% is a lot. Ultimately, I think it's just that 15% amount is why the stock tanked, because the market, doesn't want to dilute that amount and got a little freaked out. Whatever the reason, I don't think it's such a bad move, because the Very Good Food Company really does need the money, and they're ramping up their Rupert facility production, which, if you followed my channel at all or this company at all, you'd know is a major facility in Vancouver that will be the first step in solving their production bottleneck. This is really a critical step in the company's plan to be a large food brand. It's kind of like they're a rocket company that's trying to reach orbit, and if you only go half into your goals and plans, you could crash and burn. But if you invest enough and you raise enough capital and a belief in the vision of your company and its future, you can succeed and sort of quote unquote get to orbit, or in their case, not get to orbit, but they could scale manufacturing and distribution to a much larger scale and become cash flow positive. Specifically, in this case, they plan to use the money to mostly scale operations. The money that they're raising is $30 million, but they're also going to do other things like expanding geographic reach, maybe have an acquisition or two, a small one in there, research and development, marketing, etc. So I should also mention, this is not the first time since their IPO that the Very Good Food Company has relied on equity raises to fund growth and reach orbit. In fact, they discussed this in their latest quarterly results. The company has historically relied on debt and more recently the equity markets to fund its activities. Management reviews its capital management approach on an ongoing basis and believes that this approach, given that the relative size of the company, is reasonable to ensure optimal capital structure to reduce cost of capital. And then below this paragraph, they outline some more of the details that in June 17th, they IPO'd. In August, so just a few months later of again the year 2020, they raised 8.5 million in equity, and then in December of last year again they raised 13.2 million in equity, and now they're raising $30 million in equity now. So it's not the first time they've raised money, but unfortunately the dilution is now what is catching the attention of the markets because the raise amount is higher and the stock price is lower. So your dilution is higher. A good example to put in perspective the amount of capital dilution that might take place or could take place is Beyond Meat. From March 2019 to March 2020, Beyond Meat, they went from 6.9 million shares to 65.9 million shares. I'll say that again. Beyond Meat, 1 year, went from 6.9 million shares to 65.9 million shares, about 90% dilution. So dilution like this is not uncommon in small but fast-growing companies as they try to rapidly scale. Ultimately, what do I think of this drop and what am I doing with the stock? I think it's an overreaction by the market. I think it's still a high-risk stock, and I will keep it as a small percentage of my portfolio. But I think there is still some upside potential that I have detailed in other videos. And so I would be a buyer at this point in time. You have to remember, be greedy when others are fearful. Really, nothing has changed with the company other than they now have $30 million more available, and the capital structure of the company is 15% diluted. But otherwise, the still potential is all there. They still have all their same plans to build out their Rupert facility and then their Patterson facility and scale, massive rise in scale of the production and distribution of the company. But remember, I would say be greedy when others are fearful. This is not financial advice, just my opinion. Thank you so much for watching. And remember, it's in the bag.